Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly review, this time for the week ending April 5, 2024. The theme of this week is that the no lending scenario is unfolding. If you've been following the news, if you've been following us for the last year or year and a half, the debate has been about, we have a soft lending, a hard lending, so recession, some kind of a recession, or maybe no lending, no recession at all. Well, when you look at the global data that's coming out, well, the no lending scenario now has become our base case. So the recession is now an alternative scenario, and we have to recognize how broad now the signs of growth have become, and we'll dig into that through this review here. If we start with the returns on the week here, the table, what you see will be that is on the top of the table here, bond returns this week negative, so higher interest rates, and in the US, negative return on the week. So all of this is pretty much the same kind of thing that happened this week, that economic data is becoming a bit too hot for a convincing case for the Fed to start cutting this summer, and the market is starting to price that the Fed will not cut in June, not in July, but now it has moved fully to September following the jobs report that we had this morning. More on that in a minute. And also we had many Fed speakers this week taking the stage, and some went even as far as suggesting that maybe we don't have to cut rates this year, maybe it's next year. So we're starting to have these question marks in the markets. So reaction, of course, is interest rates are higher, and the stock market has to digest that. The path for lower rates maybe is a bit delayed. So of course, this does create some short-term, at least, volatility. So that was the market behavior on the week. If you look at the bottom of the table, you see that the price of oil is touching about $87 in the US. We're above 90 on the Brent, so the global index. We're seeing geopolitical pressures at play here. Of course, this week, Iran kind of joined the conversation, I would say, around the Israel and Gaza conflict. So the geopolitical risk premium is rising for the price of oil. Of course, this can have some inflationary consequences, and this will have likely inflationary consequences throughout 2024. So central banks need to take account for that. And the price of gold, which has been one of our strong conviction views that we've mentioned over the past few months, continues to do well, 2.7% on the week, 11% since the beginning of the year. So if we dig into the charts of the week, well, first let's start with the world. So the global manufacturing PMI chart on the left has broken through 50. So now we're above we're in growth territory above 50. And on the right, what you see is that the diffusion index of the countries that are showing some growth, that have their own PMIs above 50, also is showing that we are gaining traction. It's still an emerging story. It's still maybe a fragile story, but it's starting to be a more and more convincing story that growth is spreading around the world. So the gray line on the chart on the right is emerging countries. So you see that emerging countries are leading the way. You've seen growth there. For developed countries, it's still more nascent, I would say, but the trajectory is in the right direction. And this week, we had the data from China showing that after multiple months of, below expectation figures, now we're starting to see growth in manufacturing and in services. So the shores of China have been touched by this wave of reaccelerating global growth, which of course, supports this story that we're seeing a lot of traction globally. Focusing on the US, on the left, you have the manufacturing PMI, which is above 50. It was a surprise. It wasn't expected to return to growth territory, but a strong surprise. Let's see if it sticks, but it was a very interesting data point. But on the right, you see that, well, with reaccelerating growth globally, you do see some more new pressures on the supply chain. Commodity prices are starting to rise again, so we're also looking at copper, which is seeing some decent action on the price. Base metals are having some good returns. Of course, the price of oil, so commodity prices are reacting to this re-emerging growth story, and of course, this creates inflation, which will feed into goods and services as we move forward. So the risks of inflation remain alive and well. So if you're the Fed and you look at that, if you're data dependent, the case for starting to cut early is dwindling. It's getting weaker and weaker in front of us. And also we mentioned that a few times in the past, but remember that the Fed typically tends to avoid starting a rate cut path or a rate hike path too closely to a federal election. Because it doesn't want to get into the political debate or seen as participating in the political debate. So if the window of June, July is missed, it becomes likely that the rate cuts come at the end of this week. So this is all, again, being priced into the markets, and this is the markets also reacting to this data flow that I just mentioned here. So maybe just for the last topic here, closer to us, the jobs report, Canada and the US. Well, we see that both economies are going in opposite directions. We see that through the labor market. The unemployment rate has been rising on both sides of the border of late, more in Canada than in the US. And in the US, even this morning, we learned that the unemployment rate started to move lower. Let's see if it's just a bump in the road or if it's the start of a new trend. But we created 303,000 jobs in the US in the month of March. Big number. A large chunk of that comes from healthcare and government. So if you look under the hood, it's not that impressive a number, but it's still a very healthy one, I would say. Participation rate continues to rise, and this is maybe the story here. Yes, the economy is too hot to start cutting, but if we continue to see productivity growing and the participation rate rising, so more people being willing and able to work, that does lower the pressures on wages going forward. So that makes the Fed a bit more confident that inflation could be heading in the right direction. So that was for the US. In Canada, well, 6.1% unemployment rate. That's the first time, excluding the pandemic period, that we've had the unemployment rate above 6% since 2017. So that brings us back 7 years or heading onto 10 years. So the labor market in Canada is not creating enough jobs for population growth. And on top of that, wages are still growing at 5%. It was even a small reacceleration year over year. So again, we think it's not likely that we have a cut next week, but the data flow is getting more and more convincing now that it's time to get moving from the Bank of Canada. What we're watching next week, Bank of Canada rate decision, as mentioned, the consensus is no change. This is still our opinion, but again, the odds that they start cutting soon are rising, although there's still an alternative scenario. Building permits, we've been talking about Canadian housing for a good while. We're not building enough houses for population growth. February figures, it's expected that the building permits will be down 4%, so not heading in the right direction. In the US, small business optimism should rise. Inflation report for the US, still a bit too hot for comfort is what is expected, 0.3% month over month. Too hot, and a reacceleration year over year to 3.5%. We'll see how it falls, and again, how the Fed reacts to that. And the FOMC meeting minutes for March 20th will be published. So always a pleasure to serve you. I'll be back again next week.